Good afternoon, everyone, and welcome to the FMDQ Securities Exchange Limited webinar on combating currency exchange volatility through risk management tools. I trust everyone can hear me clearly. If there are any challenges, I would please just request. Okay. Good morning, everyone, or good afternoon, everyone. Slight challenge there with technology as always. Welcome to the FMDQ Securities Exchange Limited webinar on combating currency exchange volatility through risk management tools. My name is Jumoke Olaniyan. I am the Divisional Head Market Architecture at FMDQ Exchange. Before we go into the event for today specifically, permit me to share a few housekeeping rules. I will be taking the questions at the end of the presentation. Therefore, if you look at the bottom of your screens, you will find a Q&A answer section where you may please put in your questions, and I will take those questions at the end of the session where I have designated a question and answer period. Questions may also be asked via the speakerphone. Should you want to ask a question, you may also raise your hand and I will give you the opportunity at that point in time. But at this time, let me just go straight into the webinar, and I will be making a presentation. Thereafter, we will take the questions and answer as I have just shared. So today, the presentation I'll be taking will take this order. We will look at a case for derivatives adoption in Nigeria, and another look at how we can manage foreign exchange risk, as today's session will sort of dovetail into foreign exchange markets specifically and how to manage the risk in that market. We'll talk about how FMDQ Exchange and the products we have launched to the market can be used to manage this foreign exchange risk. Particularly, we'll be talking about the Naira settled OTC FX Futures product, and would give you a few more insights into the product, the market framework, its operational standards, and how it works, and how each and any one of you can access this product through the participants in the market. And then we will take the questions and answers. I'll start with giving a picture of the Nigerian financial market landscape. What we've done on this slide is to show you a few key financial market parameters. These are parameters that sort of show and gauge the direction of the market, or the temperature of a market, as you would. We've picked two very important and interesting dates. We've picked October 17, 2019, a week before the central bank circular on the bifurcation of treasury bills and OMO bills in 2019. And you can see what interest rates, fixed income, foreign exchange, and equity prices and commodity prices were as of this date on October 17, 2019. A second date we've picked is April 21st of 2020. The interesting thing about this date is the date we saw the lowest price on crude oil price, where crude oil price went to $19 per barrel, which obviously is an interesting date because this impacts a lot of things in financial markets, and even more so Nigeria, to the extent that crude oil is a mainstay and a main source of revenue for the country. And then we've seen how each and every one of these financial market parameters have fared in light of the crude oil price. We see interest rates benchmark going as low as 2%. Fixed income yield, particularly we've benchmarked the 12-month treasury bill as low as 3.97%. Exchange rate going to 388.92 as of this date. And Dangote Cement, just a sampling of an equity price moving from 145 to 136 in this period as well. And of course, crude oil price at the lowest at 19. The question is, as market participants who are on various sides of the investment decision or the investment question, either to buy or to sell, to take or to place, to import or to export, how do these parameters play? What kind of risks do these parameters play? And how do they impact the investment decision that a market participant has to contend with? And then the ultimate question, how do you deal with it? Do you need to hedge? Should you hedge as a market participant? An important question. But then let's bring it back home specifically to a few more corporates and a few more types of businesses we have in our market, whether you're a dealing member, whether you're a pension fund or a corporate. What are the considerations that come to play in your decisions or your investment decisions? With regards to interest rate, we're talking about how institutions are looking to place excess funds that they may have. This is typical of pension funds, of course. Also, you're looking for how to invest these excess funds to make more better returns. This could apply to any and every kind of corporate institution that has excess cash or excess funds on its books. You're looking at how interest rates impact your borrowings if you're an entity that is leveraged, and how this is going to impact either your working capital or your capital expenditure if borrowings is what is used to fund that. Or an issuer who has gone into the capital market to raise long-term funds via bond issuance. How do these interest rates impact you? So you can see that there will be sensitivity to each and every one of these underlying type activity that a corporate entity will be faced with. And what we've just shared is examples of types of derivatives products that can be used to hedge where you have interest rate risk. For foreign exchange risk, this impacts quite a lot of us as well, or quite a lot of corporate entities as well, especially entities that require who import the inputs or resources that are used to manufacture products locally. This also impacts those entities that have manufactured and are looking to export the product, obviously, out of the country, and then looking to earn a foreign revenue, earn in foreign currency. This would also impact entities that borrow in foreign currency, or again, an entity who is an issuer in the market, who has issued a Eurobond or invested in a Eurobond type product. Again, the foreign exchange volatility or depreciation or a change generally will impact any of these underlying activities that a corporate entity is bound to be involved in one way or the other. And how do you or can you manage this exchange rate risk? There's several products, again, derivatives products that can be used to manage these. You have FX futures, forwards, OTC FX futures, and of course the currency swaps. And then lastly, we have commodity prices. A lot of times commodity price is to some extent or a large extent an indirect impact on corporate entities. But then to you and I as individuals, it's a direct impact. The price of crude oil, we've seen the pump price of fuel, we've seen gone down. I mean, I'm sure we're all smiling and happy about that. But on the flip side, how does that impact also revenues of the federal government, which of course is a litmus test or an indication of production in the country or the economy, how government supports infrastructure and the general environment in which businesses operating. Of course, we have commodity futures that can help support that. So what we've looked at is broadly on a high level, the things that impact a corporate entity and how they may, or the kinds of products that may be used to manage those risks. But then let's delve down a little bit more into what is quite pertinent and topical in today's market, foreign exchange risk, and what has the Nigerian foreign exchange market experienced over the period, over the recent times. 2016 was the most recent time where we had quite a bit of a foreign exchange market that was quite volatile and experienced what we have again today, where we had panic buying. There was quite a bit of heightened volatility. Liquidity was low. And of course, we had what we call front loading as a result of the uncertainty in the liquidity in the market. Participants in the market obviously were looking to buy their needs for foreign exchange pretty earlier than they typically would have needed to purchase those that foreign exchange need. The chart there below simply shows you how the foreign exchange market have fared, I mean, from 2016 to date, showing you the interbank market rate versus the parallel market rate and the kinds of spread we experienced during those periods. I mean, you can see the gray lines already peaking above the orange line in 2016, wherein the parallel market was at quite a significant spread to the interbank market. And then we saw a period of a bit of stability all through 2017 into the end of 2019. And again, right now you can see we can see the parallel market beginning to peak out again above those orange bars, which are the interbank market. Again, symptomatic of the low liquidity that we have in the market. So it's a cycle, it's happening again. And how and what are the risks that corporates would face in this situation? That's a bit of what we have just discussed. And what I'll be going forward to talk about is therefore how you can use the derivative product that we have in FMDQ on FMDQ exchange today to hedge this risk that you'll be experiencing in the market. So I introduced to you the Naira settled OTC FX Futures. This is a product that is used or can be used to manage foreign exchange rate risk in Nigeria. It is a combination, if you would, of a forward and a future transaction. Basically, it's taken the best of the both products and brought it together in one. And what we've done for you there is to show you an assessment of what the product looks like. It is a futures product in the essence that we've taken all the risk management features of a futures contract, which is typically traded on an exchange, but we've given the flexibility of a forward contract such that you can match the exact size of your exposure in a foreign exchange transaction, bringing together the two together to give you what we call the Naira settled OTC FX futures contract, best of both worlds, as I would call it. So what is this product? Naira settled OTC FX futures, launched June 27, 2016. Its main purpose is for hedging foreign exchange risk. It is a cash settled product in Naira. What does this mean? The differentials on the maturity date of the contract are settled in Naira and not in dollars. As of today, or as of the end of business on Thursday last week, a total of $14.3 billion worth of contracts were open in the Naira settled OTC FX futures market. However, since inception, since the launch of this product, up to the close of business last week, a total of 47 billion worth of transactions, of OTC FX futures transactions, have been entered into in the Naira settled OTC FX futures market. A chart on the side shows you how the contract values have moved over time. From when it was launched in June 2016, you can see that there has been significant growth in the use of the product because it's a typical product that is used to hedge foreign exchange risk, which is prominent, which is a factor or reality of our market. And therefore, there's been major uptake or major use of the product over the last period. We've also shown you quarter on quarter, typically how the products have been used. And in some cases, you see that quarter on quarter, there is some trend because there are some risks that are a little bit more heightened in a quarter than other quarters. And what we've done also is to give you just an analysis of the turnover volumes month on month. Again, it has been a steady increase because there's been significant adoption of the product for hedging foreign exchange risk in the Nigerian market. What I have here is what we call the product features of the OTC FX futures contract. Nothing new from, I think, what I've said before. It's a dollar naira OTC FX futures contract because it's an exchange rate contract. It's monthly. The contracts are in monthly cycles. We currently have 60 monthly contracts, which means you can hedge out up to 5 years, depending on the type of foreign exchange transaction that you're trying to hedge. The rates of the contracts are usually quoted to 2 decimal place. This is in alignment with the Nigerian naira and the way we quote the Nigerian naira to 2 decimal places. To trade the contract, it's available, or the market for the OTC FX futures is open between 9 a.m. and 2 p.m. Daily on the FMDQ exchange. The contracts expire, like I said, it's a monthly contract, so they expire every month, and this happens on the last Wednesday of each calendar month. And on that same day, a new contract obviously is introduced into the market to keep it at 60 contracts, 5-year hedge in the market at any point in time. There are a few restrictions to trading on the contract. The contract stops trading 8 calendar days prior to the expiry date of the contract. So technically, the Tuesday of the week before the contract is maturing, the terms called trading ceases on the contract. As I shared, it's cash settled, and it's settled T+0, meaning it's settled same day of the day of the purchase of the contract. The final settlement price on the Naira settled OTC FX futures is benchmarked on NAFEX, the Nigerian Autonomous Foreign Exchange Rate Fixing. So the NAFEX spot rate on the relevant expiry date of the contract is benchmarked against the futures price, and the settlement in favor or not is determined at that based on that rate. The clearing agent and the clearing house for the Naira settled OTC FX futures is our sister company, FMDQ Clear Limited. They manage and administer the day-to-day risk management and valuation of the OTC FX futures contract from the point of execution of the trade all the way to the maturity or the expiry date of the contract. As is with or typical with futures products, and one of the principal risk management tools of a futures product is the margining process of the futures product. And so we have initial margin and we have maintenance margin. And initial margin is based on the tenor of the contract you want to enter into. These are the contract rates as we at the moment. And these can change depending on the volatility in the market or the risk perceived in the market. This is administered by the clearinghouse FMDQ Clear. Maintenance margin, meaning initial margin is required on the day the contract is purchased, and then maintenance margin is the minimum level the initial margin can go to before a top-up is required to bring you back to the initial margin requirement, and that is a 75% level of your initial margin. This is valued and tested every day by the FMDQ Clear Limited. So at any point in time, the counterparties are only exposed to a one-day level of risk as against being exposed to risk of the full tenor of the OTC FX futures contract. So what is the benefit of the OTC FX futures contract to you, to me, to the Nigerian economy? It helps manage exchange rate stability in the sense that you're able to hedge your risk. And because you're able to hedge the risk in the economy, then the need for the front loading and panic buying experience is muted. It also helps capital inflows, market depth, and liquidity. Capital inflows from investors coming into our markets to the sense that they are able to hedge their exchange rate risk when they inflow currency into the market. The inflow of currency into our markets obviously helps the liquidity in the market and therefore helps market depth, as well as more people are able to participate and obviously source the foreign currency in the market. Specifically, how does it help corporates to manage the risk? What benefit does it bring to a corporate? It helps in risk management of the balance sheet of the corporate, be it from an exchange rate funding perspective or even an investment perspective. Using a hedging tool will help that. For corporates that also particularly use inputs that are imported and therefore have foreign exchange elements to them, or an exporter who is going to sell the finished goods or its produce into the foreign market. It helps with financial planning and budgeting, because then you're able to determine a specific rate for the contract or for the pricing of your product, be it the input or the output that is to be exported out of the country. So it allows for planning or and budgeting. So participants in this market, a few of them I have mentioned in my introduction and speaking about the product itself, but to give a more detailed explanation, what we've done is outlined who the participants in the market are and the role they play in the Naira settled OTC FX futures market. This market was developed in conjunction with the Central Bank of Nigeria, who has the ultimate regulatory responsibility of the foreign exchange framework in the Nigerian economy. However, in this market, the central bank is a transaction counterparty in the sense that the central bank offers prices of the Naira settled OTC FX futures to provide the liquidity that is needed in that product. So the central bank in this context is participating as a market intervention participant, providing the bespoke pricing and rates and prices for the bespoke contracts. We have dealing member banks. These are your deposit money banks who are authorized to trade foreign exchange in the market and are registered with FMDQ Securities Exchange Limited as participants in the derivatives market. These are the transaction counterparties or the direct transaction counterparties to the trade with the Central Bank of Nigeria. The dealing member banks in this context are also the ones who facilitate the purchase of the Naira settled OTC FX futures for clients. Therefore, they're responsible for all the necessary KYC requirements for a client who wants to purchase the Naira settled OTC FX futures, and they therefore purchase it from the central bank and therefore sell to the clients in the market. So they fulfill the client's orders on the designated system for the OTC FX futures market, which is called in short form FFTRS. And they also stand good and serve as the settlement bank for all the OTC FX futures transactions. So all the margining requirements that I had mentioned or talked about in the just the previous slide that the clearinghouse facilitates on a daily basis, the settlement banks, the dealing banks stand good and are responsible for ensuring all such obligations are fulfilled on a daily basis up to the maturity of the contract. FMDQ Exchange is the designated exchange and provides the trading platform where the OTC FX futures contracts are traded. It is responsible for defining the market framework and the operational standards that guide all the participants in the market. It also organizes the market, providing ongoing interpretive guidance, clearance, clarifications, answering questions that may be required from any participant in the market, and generally just looking at how the market can continue to be improved and expanded to help all the participants in the market achieve their objective. FMDQ Clear Limited, like I had initially shared with you, is the clearinghouse for the OTC FX futures products. They manage, or they are responsible for the risk management of the product. So they define the initial and maintenance margins, having done all the risk assessments. They conduct the daily mark-to-market on the OTC FX futures to determine any variation margin that is required to be collected from the dealing member banks. They provide all the reporting to the dealing member banks. They facilitate the settlement of the contract on the maturity date. So they calculate what the settlement will be using NAFEX, like I had shared, and therefore communicate what the settlement value is and facilitate the settlement instructions to the respective dealing member bank accounts. And finally, they generate what we call settlement advices, which are like contract notes to the respective counterparties who have entered into transactions on the FFTRS. And finally, the community, I believe most of who are here today, the clients. These are entities who have used the OTC FX futures to hedge risk by entering into such transactions. So these would include institutional investors, foreign portfolio investors, foreign direct investment investors, asset managers, fund managers, corporates, commercial institutions, pension funds, the banks themselves, because they also are exposed to risk in their daily dealings, and so they can go into OTC FX futures, and the government, the federal government, or its parastatals who have a need or have any role to play in the OTC or any need for the OTC FX futures product. A primary factor consideration for being able to use the Naira settled OTC FX futures is that the transactions that are eligible to be hedged using this derivative product have to be foreign exchange transactions that are eligible in the official foreign exchange market in Nigeria. So there's a whole framework and operational standard that defines the type of transactions that are eligible to be hedged using the OTC FX futures contracts or products. And they closely relate or closely tie in with what the formal or foreign exchange market eligible transactions are. So what we've done is just highlight them again here in some high level bucket. Visible trade transactions, so obviously your LCs, your bill for collection type transactions would typically be eligible to be hedged in these OTC, using OTC FX futures. Invincible trades, so these are your payments, your dividend payments, your airline remittances, and a list of transactions we've called miscellaneous payments here, but there are quite a lot of them defined in the Central Bank Foreign Exchange Manual. You have consultancy fee, you have medical bills, you have demurrage, quite a whole list of invisible transactions as defined by the central bank are also eligible to be hedged in this market. You also have foreign portfolio investments. Obviously, these are investments of inflows of capital, foreign currency into the country. And what is interesting here is you can hedge both your principal that was inflowed into the country, as well as the returns you made from the investment here in Nigeria are also eligible to be hedged using OTC FX futures. Foreign direct investments, long-term investments such as equity capital, foreign direct investments such as investments into plant and machinery for production in Nigeria, such are also eligible to be hedged using the OTC FX futures, as well as whatever returns you make off those foreign direct investments, they are also eligible to be hedged. Corporates who have taken foreign currency loans but inflowed it into Nigeria and utilized in Nigeria, meaning they have been converted to Naira and obviously evidenced by what we call the certificates of capital of importation, are also eligible to be hedged using this product. Likewise, some other transaction types such as loan write-offs or provisions for non-performing loans, subject to some sort of approvals as defined by the Central Bank of Nigeria. More recently, we've just upgraded or expanded the market framework to include one or two types of transactions, such as FX forwards for importation in Nigeria, for the importation of capital into Nigeria. This particular type of transaction is eligible for banks, obviously, who are the ones who facilitate the inflow of foreign currency into Nigeria. And generally, there will be other types of eligible transactions that we may approve, in conjunction with the central bank from time to time, because we look at the market, we assess the market on a regular basis and see what the needs are. And based on that, we can expand, amend, update, or revise the framework for the market as may be required. So this is the broad, high-level categorization, if you would, of the types of transactions that are eligible to be hedged in using OTC FX futures. So I know this slide looks very busy and very complicated, but don't worry, it's a very simple slide. With this slide, I just want to explain to you the process of how you get into OTC FX futures. How do you use the OTC FX? How do you get to use the OTC FX futures? Obviously, the starting point would be you have an FX risk exposure or future FX risk exposure, and you want to hedge it. So you will need to approach your bank, a futures bank, a dealing member bank, a bank that has been registered to participate in the OTC FX futures with FMDQ. The futures bank will purchase wholesale from the central bank. What do I mean by wholesale? The futures bank can buy or purchase an amount larger than just your figure. It may be a bulk of clients' transactions that they purchase. And then the futures bank will sell to you, the client, the portion that you have requested. Please note, obviously, that the futures bank would have to determine, first of all, that the transaction, underlying transaction you're trying to hedge the risk, is one of the eligible transactions we've just mentioned in the slide before. Not only that, the futures bank will also need to determine that the transaction documentation required for that transaction, that FX transaction, are complete and eligible. All of this is defined in what we call the OTC FX Futures operational standards. So it is the responsibility of the futures bank to determine that, first of all, you have a transaction that has been designated as eligible, as defined, and that you have the required documentation to prove the eligibility of the transaction before they go into buying the OTC FX Futures transaction on the system. So of course, they'll buy the OTC FX futures on the system. And at the point of purchase of the OTC FX futures, the futures bank would need to provide the initial margin, which we had discussed, for the value of the contract that they want to purchase. When the futures bank, does the purchase on the system, the futures bank then goes ahead and also sells that transaction to the client, and it is also recorded on the futures trading system, FFTRS, as well. So when that is done on FFTRS, the transaction flows into the FMDQ clears system. It's a clearing, risk management and settlement system. It takes the record of the transaction, and therefore it values it on a daily basis to see the movements in the risk rate and determine if there's additional obligation that will be required to be provided, obligation in the sense of variation margin. And when this is done on a daily basis, if there's a need or if the margins drop, obviously, below the value has been determined as the maintenance, 75% of initial margin, a margin call is made on the futures bank to top up on the margins. So this is done daily by the FMDQ the clearing house. This will be done all the way up to the maturity date or the expiry date of the OTC FX futures contract. On this day, FMDQ clear, which is now, I'm talking to 0.5, will now then value the contract against the spot NAFEX rate on the expiry date of the contract and determine what the final settlement value is on the contract. If the contract is in the favor of the client, then it will be paid obviously to the settlement bank's account. If it is not, then the settlement bank's account will be debited for the value. And then the settlement instructions are sent to our settlement agents, our settlement partners, the central bank or NIBS, as the case may be, depending on whose account is being debited or credited for the value on that last day. And then finally, your transaction settlement advice is issued on request of the dealing member bank and obviously on behalf of the client as required, and that can be sent to you. So on a very high level, that is what the flow of the transaction of how you can get into OTC FX futures is. Just to recap, a client would need to approach its bank to request to be able to purchase OTC FX futures, minding that it must have an eligible transaction and the required documentation for the eligible transaction for the bank to be able to go ahead and purchase the OTC FX futures contract on its behalf in the market. So that is a summary of the OTC FX futures contract and the product and how it can be used to hedge in the Naira settled in the current Nigerian FX market. However, if you recall, what we did in developing the OTC FX futures was a hybrid of an FX forward and an FX futures contract. to bring the Naira settled OTC FX futures. However, FMDQ Exchange is also working on another product, which is the standardized futures contract. So in this case, we will be taking and developing products that tick all the boxes of a futures contract without the hybrid of what the forward contracts look like. So they will be standardized, they will be traded on an exchange, and they will have all the risk management features of a futures contract. And in doing that, there's a whole derivatives market development project that we're running on, which will bring this product to life. And in doing that, we had started this about 18 months to 2 years ago, and have run in phases in developing this market. First phase of this market was where we did a feasibility study of what will be required to introduce a standardized exchange traded product to the market. We did that, had a feasibility study, had market engagement, and received feedback from the market. We then went into brainstorming on how we can put together a market structure and a market framework that will address all the concerns that we had heard from the market engagement, from the feasibility study, as well as from learning from international markets that have been successful at developing such markets, what it is we needed to put in place to develop such a market in Nigeria. And that is what phase one of the project was. So we had a market assessment, developed a framework, and had some preliminary introductory training sessions and engagement with key stakeholders, including the regulators, including corporates, including the banks, and anyone who was a potential participant in the derivatives market. Having done all of that assessment and come with and put together a design that we felt would work in the market, we are now in phase two of that, wherein we are now putting the pieces together. So we're actually building the blocks. If you liken it to an architect, the phase one was where we drew the design on, of the house. We're now building the house in phase two. We're putting together the legal and regulatory documentation. We're educating market participants. We've had several sessions, and we will continue to have sessions up to the launch of the market and even after. And of course, we're working on the system for both the trading, the clearing, and the settlement of such product, as well as the risk management of that product that would help ensure that that market is a world-class derivatives, exchange-traded derivatives market. Once phase two is complete and runs up to the end, the next thing would be to launch the first of such products or two products into the market. To give you an indication of timelines, we're looking at launching this product or launching this derivatives, exchange-traded derivatives market this year, 2020. So, I mean, expect to hear from us. There will be several more engagements with market participants on this derivatives product and this derivatives introduction of this product to the market. There will be several training sessions offered by the FMDQ exchange to elucidate on what the product is, how it can be used. Case studies will be developed for different types of stakeholder community and how they can use it. And we will be calling and providing these classes and these trainings to our stakeholder community in the nearest future. The benefits that this will bring to the market obviously are numerous, not just the market, but obviously the economy as a whole. The foreign exchange market is like a nerve center for the financial markets, like nervous system of a body, particularly for Nigeria because of the ratio of the imports and the use of imported materials in the Nigerian financial market, both for materials, both for funding, even for interest of investors from foreign countries in our financial market. So it is important that we have a derivatives product that meets the needs of everyone in being able to manage the exchange risk that they face in the financial markets. So the benefits are therefore numerous. So with this, I think I've come to the end of my presentation, and I see that I'm very much on time with the time I had allocated to speaking to this presentation. And therefore, we'd like to just take this time now to go into questions and answers that you may have. So please, like I had shared with you, please put your questions and answers in the Q&A session, and I will take up your questions from there. Okay, so good afternoon. Good afternoon. Several people greeting. Thank you very much for the greetings. I would take next question. So I have someone, Kasimu is requesting, I would like to know if the FX market will be extended to Forex trading as done by Alpari, Hot FX, Hantex Africa, and others. Kasimu, this will have to be determined by the central bank's foreign exchange policy or foreign exchange framework for the Nigerian financial market. If the central bank extends this to that, then the derivatives market will be extended to that. But at the moment, I am not aware that these tradings are eligible in the formal foreign exchange market. If the central bank does, then it would become eligible. Would you share the presentation? Benson is asking if the presentation will be shared. Absolutely, Benson, the presentation will be shared with participants. I have several questions here asking if the presentation will be shared. That I have answered will be done. It will be shared. Question again. Is the derivatives market only for institutionals, or will the retail market be able to participate via the stock brokerage community? To answer this question again, if you avert your mind back to the start of my description of the product, first of all, the underlying transaction is what is important. If the underlying transaction is eligible in the foreign exchange market as defined by the central bank's foreign exchange framework, then it doesn't matter if it's an individual or retail, as long as the eligible underlying transaction is eligible and the transaction documentation are available and valid, then the transaction is eligible to be hedged. So it's not structured about whether it's an individual or an institution. It is based on what is the exposure you want to hedge. Once there's a future exposure that is eligible to be hedged and the necessary documentation for that, then it will be eligible. I have a question from Chinyere, excuse me. Hello, Jumoke. Can you be specific when launch of the derivatives market will take place? Chinyere, from 5 years of being a product manager, you will never find a project manager who will give you a specific date. You would typically hear us say, it will be launched when it's launched. But what I can give you is that this will be launched in 2020. What I can also say is, obviously, before we launch, there will be series of information, notices and communications out there to the market about the time it is going to be launched. And of course, when we're closer to the specific live date, there will be notice to that point as well to say this is going to be launched. Thank you. I have a question from Momotola. It says, thanks for the presentation. Given the lack of liquidity in the I&E window, how efficient is the OTC FX futures in truly hedging FX risk? Thank you for the question, Momotola. Let me explain in FX risk. FX risk can have two, in FX risk as a bucket, you have two factors. You can have liquidity risk and you can have the price risk, which is liquidity risk is sourcing the funding, obviously. The price risk is the rate at which you purchase the contract or the FX risk. Futures contracts generally do not hedge liquidity risk. They hedge your price risk. What do I mean? They hedge the rate at which you should be able to source your foreign exchange on the maturity date or on the expected date of funding. Now, hedging in financial markets, barring one or two types of derivative products, have exact hedges. Typically, you either are overhedged or underhedged, but the point is that you narrow to the barest minimum your exposure. So the OTC FX futures contract helps you with managing the price risk as close as you can to the maturity date or the date in which you now need the funding of the FX on the to make the necessary payments or make good on your obligation on the underlying FX products. Nonye is asking a question. Thank you very much, Jumoke Fepri. Can you advise how the new futures product would be settled if the FX illiquidity remains through the time of launching? Again, Nonye, it closely ties to the question I have just answered. Futures do not hedge liquidity. Futures hedge price risk. Now, another factor of the type of exchange traded derivatives contract that we want to bring to the market is that it would not be bundled or coupled with the eligible underlying transaction the way your OTC FX futures contract is tied. The exchange traded derivatives contract would be, for lack of a better word, independent of the eligible underlying transaction. What do I mean? The way eligible underlying transactions have been defined in the OTC FX futures here will not be applicable in exchange traded derivatives contract. They will be standalone future exchange derivatives contract. So therefore, I believe part of what Nonye is talking about is this requirement in this OTC FX futures where you have to show the purchase of spot at the end of the contract to be able to get your settlement advice. That will not be the case in the exchange traded derivatives market. The exchange traded derivatives market we're bringing to bear would be the type that you are familiar with, that is traded globally, where the eligibility of the eligible underlying transaction is separate and distinct from the hedge transaction itself in the OTC FX futures, in the exchange traded derivatives market. Pradeep, I hope I pronounced your name properly. I just want to know what happened if there's no liquidity in the market. Pradeep, would you please clarify if this is with regards to OTC FX futures market or the exchange traded derivatives market? I'll take your question when you clarify that. Omotola, follow-up question. I hope I'm not being too fast. I'll try to slow down. I just noticed that. What is the FMDQ doing in partnership with CBN to resolve the liquidity challenges in the I&E window? Omotola, I think all participants in the market, not just the FMDQ and the central bank, including the dealing member banks, we're all putting heads together to see how we can address this challenge. I mean, it is a challenge that we're all facing in the market, be it the central bank, FMDQ, dealing member banks, corporates. It's a factor that is impacting and affecting everyone in the market. What we're doing is rubbing heads together, looking at what can be done in conjunction with the central bank to address these challenges. So we're providing information, we're providing feedback from market participants, from engagement we have with them. We're proposing solutions, from learning points we've seen globally in other markets as well to the central bank, and all collectively talking and engaging to see how this can be addressed in the market. We have a question here from Onyebuchi. Thanks for the presentation. Please, what is the exchange position on externalization of gains on OTC FX futures, where I have a foreign investor dividend to remit and I hedge it? Do I need to externalize? Onyebuchi, this seems to be a very specific question to this transaction type. May I please kindly request you just do me an email on this, and I'll provide you a more detailed response, as I think, so as not to confuse the community we have here, because I do believe this is specific to a type, an underlying transaction. So I'll be able to provide you a proper answer when I have further context on the transaction. Eric has a question here, says, good afternoon. Is the OTC FX futures contract immune to changes in macroeconomic indicators, interest rates, inflation, etc.? Eric, in a sense, no, it is not. What do I mean? Interest rates, inflation impact foreign exchange. So, and it is a critical factor for defining what your OTC FX futures contract prices will be So it is not immune. In fact, it is sensitive to that. And that's why you see the OTC FX futures contracts actually change from time to time. Okay. I have a question again from Pradeep. Is there any window to extend the contract if there is no liquidity? Pradeep, again, there's some specific requirements to what can be extended. So if you have a particular transaction type or particular scenario, I will be very happy to take your question via an email so that I can provide you a proper clarification. The reason being is I can't just say blanket yes or no. There are some that are eligible to be extended and some that are not. So it would be better for me to take your question on that point one-on-one. And I will leave my an email or we will share the email where you can send in your specific inquiries on the OTC FX futures contract to that point. Idris is asking, please, is there any plan for commodity futures in the derivatives markets? Absolutely, yes, Idris. But the commodity market, as you imagine, in Nigeria has some way to go. If you compare them to the fixed income market or the foreign exchange market, the commodity market itself, I'm talking about the commodity spot market, not even the derivatives market yet, has some way to go. So there are some key fundamental factors that need to be addressed in the commodity spot market, some key fundamental infrastructure that need to be put in place for the derivatives market to be fully functional and successful. So yes, there are already conversations and discussions going around all of this, even in the market, even from the SEC's point of view. The SEC, just released a commodities market ecosystem research paper and sort of master plan in 2019. And I'm aware there's quite a lot of effort and work going into delivering all the recommendations in that plan. Question from Onyebuchi says, what instruments are the margins invested in, treasury bills or others? And hope I get the returns on the investment of my margins. Onyebuchi, these margins, obviously, as you imagine, the direct communication or interaction between the clearinghouse is with the dealing member banks, and they are the ones that we engage with on this. So yes, the investments are in as liquid securities and secure securities as possible, T-bills being one of them, and yes, some returns are made to the clearing members, the settlement banks on the investments. I make this distinction, Onyebuchi, because if you look at the transaction dynamic I shared with you, the banks are the ones that have the relationship with the clearinghouse directly. And then they are the ones, the banks are the ones who manage the relationship they have with you, the clients. So whether you receive returns or not between the bank and the client, that is a relationship between the bank and the client, which FMDQ does not regulate. But in our relationship with the banks, the answer I've provided is what obtains. Thank you very much, Elizabeth, for that. Elizabeth says, can we get a list of FAQs? Yes, Elizabeth, we are working on a list of FAQs from the various interactions we've had with banks and some clients over the years. We're putting together typical questions, typical clarifications and inquiries we receive, and we'll publish this to the market very soon. With the caveat, obviously, that where in doubt, please engage FMDQ and we'll provide you the necessary clarification that you require. Question from Obo. Obo says, thanks for the presentation. I'm concerned about your planned launch of the derivatives market this year, given the COVID-19 pandemic, etc. How are you planning to sensitize the Nigerian markets? It appears awareness levels among Nigerians is currently low. Thank you very much for this, Obo. I would not go as far as calling it Nigerians, because as you would understand, if you understand in transaction, the market structure, that product is not going to be open open to all and everybody. It would have to be the participants that will be able to trade the product directly on the platform will typically have to be institutions we call dealing members. And we've had several engagements with dealing members. But not to take away from your question, engaging and letting what we call end users, these are the participants or who will use the product to hedge the risk they're faced with. Some of it has been ongoing, but we have a lot more coming in the immediate and the near future. With regards to your comment about COVID-19, I believe that we all agree that the new normal is here to stay. The way we've evolved from having physical sessions on almost everything and moved to the use of technology, such as the webinar we have today, would come hugely into play in how we educate stakeholders in the market going forward. Some of this we've already been engaging in even over this COVID period with our members on FMDQ Exchange, and we will continue to leverage and expand on how we use these mediums to provide the necessary engagement sensitization with key stakeholders for the development of this market. We quite understand and acknowledge that sensitization is a key part of the success of any market. So we don't take this lightly. We're going to, have plans and we are going to do a lot of it repeatedly before the launch of the derivatives market. Engineer Kweme is asking, will the FMDQ FX derivatives market be accessible via the new fixed income retail market platform which FMDQ is developing so that stock brokerage community can access it? Engineer Kweme, I will kindly ask that I answer this question on a one-on-one. Again, please send me this question so that I can have further clarification on understanding what you are referring to. I believe there's a specificity to this question, so permit me to take your question one-on-one. Another question from Onyebuchi. Why has the FMDQ embarked on frequent repricing of the contracts recently? Don't you think such repricing bolsters uncertainty? Onyebuchi, first of all, may I clarify, FMDQ does not price the OTC FX futures contract. That is not FMDQ. As was presented during the, as I talked about during the presentation, FMDQ is simply the platform on which we bring together all the participants to trade in the market. The person who provides the pricing is the Central Bank of Nigeria, and therefore the repricing is done by the Central Bank of Nigeria. However, may I clarify that just like any transaction or any product in the Nigerian financial market, or even in any financial market globally, there are markets move, prices move. The interest rates and the FX rates that are used to derive the futures price moves, therefore the futures price itself also will move. So that is what the pricing is all about. The pricing is as a result of the factors that are used to determine the futures rate, which is your interest rates and your FX rates moving. Those are the reasons why the futures rates also are repriced. And that is why. So to clarify again, FMDQ does not do the repricing. The central bank is the one who offers the prices in the OTC FX futures market and does that. Okay, permit me to go back to one question that I had answered before with regards to margins. Specifically, currently, banks that provide the margin to FMDQ provide the margins to FMDQ in fixed income securities. Actually, they provide the margins in bills and bonds. So as you would imagine, there's no interest to pay on that. So because I said yes before, let me clarify that today, as we speak, the banks provide fixed income securities to FMDQ as their margins. So there's no interest paid on those margins. Hey, however, again, to clarify to you, like I said before, if you paid margins to the bank, the conversation on whether to receive interest or not, obviously will have to be had between you, the client, and the bank, as against having to come to having that discussion with FMDQ. Before we go ahead, please, I would just like to inform you that we'll be putting up a survey, please, which would like you to just, answer questions on how you found this webinar and what more you would like FMDQ to do with regards to this webinar, this topic, and perhaps any other topic. So a poll will be coming up shortly. We please just ask and encourage you to please help us answer and put up this question, answer these questions. With the permission of the House, I think I'm just going to take maybe 3 more questions because I believe we're at our time. I see there's still a lot of questions here. We have about 20 questions from what I can see. I'm just going to run through 3 more, and we'd like to let you know that we will take all the questions here and we'll provide answers and clarifications when we communicate the presentation to all the participants here. A question from, I'm sorry, I don't have a name here. It will have been interesting to have your name, please. So let me go to the next question. Balaji is asking, currently we can hedge on the buy side. Going forward, can we expect hedging available on the sell side as well? Balaji, I believe you're speaking to the exchange traded derivatives product that we're talking about. Absolutely, yes. There will be both bid and offer prices in the market, the exchange traded derivatives market, which means you will be able to hedge both the buy side and the sell side. Next question I have here is from Dr. Sandra. What are the legal consequences of using derivatives? Apart from the SEC rules on derivatives and CCP and the CBN guidelines, don't we need enhanced derivative-specific regulation, such as the US Dodd-Frank? Dr. Sandra, the Company and Allied Matters Act amended that is currently going through the legislature actually has the necessary piece of legislation that would support not just derivatives in Nigeria, but actually the whole financial markets with regards to finality of transactions in Nigeria. And that is highly and basically what we need. The extent of the US Dodd-Frank Act and whether we need such an extensive act in Nigeria the jury is out on that yet, but I do believe there's reviews, legal reviews, and being ongoing on that. However, what has been done in the Company and Allied Matters Act amendment, as well as the Investments and Securities Act review, is being the critical requirements to support the integrity of the financial markets have been included in those pieces of legislation and will fully and actively support the derivatives market and, in fact, the whole financial market as a whole, providing it further certainty and risk management considerations in our market. And the last question I will take at the moment is from Biola Junaid. When will FMDQ start accepting cash in lieu of securities collateral as margins? Biola, we are looking at accepting cash in the very near future. We're looking at that assessment. There are several considerations being put into place for that purpose. We're looking at the liquidity in the system, impact on banks' balance sheet when this is done, the extent to which the market will grow, and how this will impact, banks' contributions to the market. So based on that, we expect that we should be able to accept cash in lieu of securities soon. Of course, as is the practice with FMDQ, where this is the case, we will have engagement with the participants in the market. We will share the proposals, have us brainstorm together on it and come to an agreement on what is workable, and then before that is launched into the market. At this point, ladies and gentlemen, I will just stop at this point. And as I have shared, all other questions will be taken and we will provide responses to the questions and share with the attendees on this call today. Also, as I have shared, we do have the webinar and the poll put up. We please ask that you help us just answer these questions and provide further insights to guide further sessions that we will have as FMDQ. So at this time, I hope this session has been very useful. I hope it has made clarification with regards to the OTC FX futures contract and how it is used. And I hope that you've all found it elucidated. On behalf of FMDQ Securities Exchange Management, I say thank you very much for joining us and do have a good afternoon.
International now.